السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos. Pennants are a class of chart patterns that closely resemble the flag patterns and symmetrical triangle patterns in the way they form and give breakouts. But if you were to consider a pennant and a flag as two brothers, then the pennant is the more aggressive brother due to the explosive breakouts it provides and the reward for risk it generates. Now there are two types of pennants, bullish pennants and bearish pennants. Let us focus on the bull pennants first. Now the bull pennant is a chart pattern that forms a triangle during the pullback. Now it consists of two parts. The impulse move, which forms the leg or the pole of the pattern, and the correction move, which is formed as a result of the pullback. Now you may ask, what is the difference between a bull pennant and a symmetrical triangle? Because they both look similar. Now the answer is quite simple. The difference is in the duration of their formation. With a symmetrical triangle, you can clearly see the swings of the pattern. However, the candles of the bull pennant are too crowded and too volatile for you to see the swings. Regardless, a bull pennant is more similar to a bull flag pattern. Now, as I have cited earlier, bull pennants creates a more explosive breakout than bull flag pattern. Now let me explain the reason why. I hope you have seen videos in which a Coca-Cola bottle is shaken and then thrown onto the ground. Now the cap explodes and the bottle flies off. I don't want to go deeper into the physics of this, but one of the factors that triggered this event is actually the shape of the Coke bottle itself. If you try the same experiment with a Coke can, you may not get the same result. Now the bottle is shaped similar to a nozzle, with the width of the bottle becoming narrower towards the top, in comparison to a can where the width is almost equal throughout. So what's the deal? Once you shake and throw the bottle, the gas pressure builds up and the Coke wants to get out, and the easiest exit is through the cap. But as they head towards the cap, the width starts getting narrower. The pressurized gases inside the bottle would go into rage mode and blast open the cap. Please don't blame me for this terrible physics lesson, but the point that I'm trying to prove is that the same thing happens with buyers and sellers in a bull pennant pattern. The shrinking prices from left to right of a pennant pattern is a sign of impending volatility, as both the buyers and sellers are itching to get out of the pullback. Now this can result in a rather explosive breakout. But since the bull pennant pattern is not a trend reversal pattern, instead it is a trend continuation pattern, we will only look for buying opportunities. This means that you are better off trying to use this pattern to ride on the existing trends rather than catching the bottoms. Now let us talk about the entry, stop loss and target criteria for this pattern. Now starting off with the trade entry criteria, one of the most costly mistakes that traders make while trading the pennants is entering a bull pennant too early. As you know, ranging markets or even pullbacks can be challenging to enter for two main reasons. The range can overshoot or the range can undershoot. Now overshooting happens when the market is highly volatile and the prices will move beyond the trend line more often, forming false breakouts. Now undershooting is the opposite, that is the price fails to test the trend line every time. In case of a bull pennant, we should be more cautious about overshooting due to the tight range. So what would happen if you buy as soon as the breakout above the trend line happens, or if you place a buy limit order above the swing high? More often than not, the price could easily touch your buy order and reverse back into the range, forming a fake out or overshoot. Now this can be annoying and can result in losses. So what is the key here? Now the ideal thing to do is to wait for the bullish breakout candle to close above the pennant line. If the price makes this kind of a move, it's clear that the buyers who got squeezed finally managed to break out strongly, similar to the case of an exploding Coke bottle. So you can look to buy above the breakout candle's high price. But sometimes the breakout candle will be too large and you will be buying at a very high price, thereby affecting your reward to risk ratio. The best move in such a situation is not to take the trade at all, or you can wait for a pullback or retest back to the breakout level and then take an entry when the price starts to move higher. But because of the explosive nature of breakouts from the pennants, the chances for a pullback or retest are fairly dim. So the best possible entry could be above the breakout candle high. Now, validating the breakouts using volumes and other momentum-based indicators can be a good practice. During the pennant consolidation, the volume has to decrease due to the evident shrink in volatility, and the breakout has to be supported by higher than average volumes, which could indicate a rise in the buying interest. Now that you have learned how the bull pennant works and how to enter it, let's talk about how and where to set the stop losses when trading the bull pennant pattern. As I have already discussed, you don't want to set your stop loss at obvious levels like support and resistance, swing highs or lows, etc. because you can get stop loss 100 easily. So your stop loss should be at a level that if crossed invalidates your trading setup. Now we are trading a bull pennant here and the pattern is deemed invalid when the price breaks and closes below the bottom trendline support. So you have to keep your stop loss level below this trendline support or below the swing low level to be precise. Now there are still chances of long wicks due to the overshooting issues which can take out your stop loss if you keep it very tight, and then the price can move higher in the desired direction, which can be really frustrating. So to be extra safe, you can give your trades more breathing space or buffer by setting the stop loss some distance away from the pennant market structure using the ATR indicator. Now once you identify the swing low of the bullish pennant pattern, you can set the stop loss 1 ATR below the swing low level. And finally, let's learn how to set a target for the bull pennant patterns. Now there are many ways that you can exit your winners, and one of the standard approaches is to have a predetermined profit target based on the length of the leg or the pole of the pattern. This is called the price projection method, and here you have to first measure the length of the pennant leg, then project this length from the breakout point above the resistance trend line. Now this will be your profit target. You can also choose to trail your stop loss until the market takes you out of the trade. Now, is this a better option? Think about this. The bull pennant pattern usually appears in a strong trending market or just after the price breaks out of a range. So in such market conditions, there is a lot of potential for the trend to continue higher, and the only way to ride it is to trail your stop losses. Now, to trail your stop loss in the best possible manner, you can use the indicators like moving averages or Chandler's stop and only exit the trade if the market closes below it. Moreover, it is a much better option if you use a combination of both the price projection method and the trailing stop loss method, so that you can gauge the potential of the move beforehand using the projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss method, thereby not impacting your psychology and avoiding any big losses due to price reversals. Now that you have learned what a pennant is and how to trade one, it is essential to make a note of where to find one. So what are the different types of market condition where you can find a bull pennant pattern? Now, bull pennants can be found almost anywhere, be it in uptrend, range or downtrend. The only thing to remember is that whenever it forms in the market, the bull pennant is a bullish continuation pattern, and our bias should always be looking for long trades only. With that in mind, let's talk about each case separately. First, you need to define what an uptrend is in terms of your trading style and time frame you trade. Because if you can't define a trend objectively based on your requirements, then it is difficult to spot a bull pennant setup that satisfies your trading style. Now, the easiest way to define a trend is by using a trend filter, such as a moving average. Now, you can use any moving average like 20 period, 50 period or 200 period, etc. to identify the trend based on a short-term, medium-term or long-term perspective. Let's say I have a medium-term outlook, or I am a swing trader and I make use of the 50 period simple moving average to define the trend. Now, if the price is above the 50 period moving average, it means the trend is bullish for me. Then I will look for bull pennant opportunities. And if a bull pennant pattern is spotted, then you can look to take a long entry above the breakout candle. And since we don't know how long the trend lasts, you can even use the 50 moving average as your trailing stop loss, and we would exit only when the price closes below the 50 moving average. So here, not only do we use the 50 moving average to filter trends, but we can also use it to book our profits. Since the bull pennant is a trend continuation pattern, you might have the idea that this type of setup is unfavorable. So how exactly are we planning to trade the range market? Literally speaking, we are not trading the range market. Now what am I suggesting? Now it means that instead of trying to buy the highs and lows within the range, we wait for the range to potentially end. That is, we look for tight consolidations or build-ups in the form of a bull pennant pattern which is forming near the resistance level. So the moment you see a bull pennant forming at the resistance, it tells you that the buyers are starting to dominate and an explosive breakout is imminent. You can look to enter above the breakout candle or when the price closes above the resistance, and maybe you will even get a retest if you are lucky enough. Now the stop loss and the targets are same as we have discussed earlier, and since there is no valid trend, you can use a tighter moving average such as a 20 period moving average if you wish to trail your stop loss. Even though the bull pennant is a trend continuation pattern, there's still a way you can profit by using the bull pennant as a trend continuation pattern even on a downtrend. Now, this method has to do with the market structure. Here you have to look for a few things before you proceed. First of all, the price must close above the downward trendline resistance. Now, we are talking about a break in the downtrend structure. Then, if the price forms a bull pennant above this trendline resistance, you have a jackpot trade. What you're doing here is trading between an ending downtrend and a potential starting uptrend. So you can benefit tremendously if you are able to catch the uptrend from the start. Now the entry, stop loss and target conditions will be the same, and similar to the range market strategy, I still suggest you use a tight trailing stop loss such as a 20 period moving average, since we are taking sort of a contrarian position. I won't go into all the details of a bear pennant. This is exactly the opposite to bull pennants. Now it is a bearish continuation chart pattern. It has a leg comprising of impulse candles with a strong bearish body, followed by a tight consolidation associated with smaller candles and a contraction in volatility. We expect the price to break out explosively below the trendline support level and continue with the trend. Even though this pattern is usually found in a downtrending market, we can also spot it when the price is about to break down from a range below a support level where a build-up is set up in the form of a bear pennant pattern. You can even find it at the end of an uptrend where the break of the structure is accompanied by a bear pennant pattern. Now, if I were to discuss the entry criteria, we will only look for shorting opportunities. Since the breakdown is expected to be explosive in nature, we can look to enter when the breakout candle gives a close below the trendline support. You can then short below the low of the breakout candle. In case if the breakout candle is too large and is affecting your reward to risk, it is better to drop the trade or wait for a pullback to the breakout level, which happens less often in the case of a pennant. So it is up to you to decide where you want to enter. Now make sure to validate the breakdown every time using volumes or momentum indicators or both. Now the volume generally declines during the pennant formation and it increases above average when the breakout happens. Now the stop loss can be kept above the swing high level of the pennant, and providing 1 ATR buffer above the swing high can deal with the unexpected overshoots and stop loss hunting. Now the target can be kept by using the price projection method, where the length of the leg is set as the target by projecting it below the breakdown point, or you can adopt the trailing stop loss method by making use of suitable moving averages when you are planning to ride the trend, and you only exit when the price closes above the moving average. Now moving on, we will focus on the triangle patterns, namely the ascending triangle and the descending triangle chart patterns. So let's start with the ascending triangle patterns. The ascending triangle is a bullish chart pattern that signals the market is about to head higher. Now, as you can notice, the ascending triangle has a series of higher lows that approach a resistance line. Now, this is a sign of bullish strength, and for a few possible reasons. Now, the higher lows are an indication that the buyers are willing to buy at higher prices. Now, think about it. If the buyers were not willing to buy at higher prices, you won't see higher lows coming into the resistance. Now, the fact that the market forms a series of higher lows tells you that there is demand even as the price continues higher. The second point is that there is a lack of selling pressure. So if there was actually a strong selling pressure, the price would not remain at the resistance for a long period. Instead, it would rather move lower very quickly. But since the price is hovering near the resistance, it means there is a lack of selling pressure even though it's an alluring level to sell. Yet another point to keep in mind is that there are a lot of buy stop loss orders that are clustered above the resistance, because as the price retests the resistance every time, more traders will look to short the market and they will place their stop loss above the resistance level. In such a situation, think about what will happen if the market breaks out higher. Well, all these buy stop loss orders will be triggered and this will fuel further price advances towards the upside. So don't make this common mistake when trading ascending triangle pattern, because most trading books will tell you to go short when the price is at the resistance level. But not every resistance is meant for shorting. Instead, you must watch how the price approaches it. Since you have learned that higher lows coming into the resistance is a sign of bullish strength, this means the market is likely to break out higher from the resistance. And the last thing you want to do is to go short and trade against it. I hope things are making sense. Now we will talk about the entry criteria. So how to better time your entry? Well, there are a few ways to do it. The first approach is to go long when the price breaks above the highs of the ascending triangle or above the resistance level. Now all you need to do is to place a limit buy order above the resistance level and you will be immediately long when the price breaks above the highs. If the breakout is real, this is one of the best prices to enter. But this method is very risky and chances are it might be a false breakout. The next method is similar to the previous approach. The only difference is that you wait for the price to break and close above the highs of the ascending triangle pattern. You can enter long above the breakout candle highs once the candle closes. This method reduces the likelihood of a false breakout, but if the breakout momentum is quite strong, you will be entering at a very higher price. So if you are an experienced trader, then you can even enter the market as the price pulls back or retests to the resistance line of the triangle pattern. Now this can help you enter the trade even if you miss out of the breakout move, and it offers a better entry price than waiting for the close of the breakout candle. But the issue with this approach is that the market may not give a pullback or retest every time. So it is up to you to choose the entry type that you like based on whether you are a conservative or aggressive trader with your approach. Now make sure to validate the breakout with volumes and other momentum indicators to see if there is actually an interest in the market participants to take the prices higher. Now we will learn how to set a proper stop loss so that you don't get stopped out too early. Now it doesn't matter whether you are trading the ascending triangle, breakouts, pullbacks, etc. because the concept is the same. Your stop loss must be at a location that if reached will invalidate your trading setup. Now this means if the market hits the stop loss, you will automatically know you are wrong. So a stop loss below the resistance level is not a very good idea. So where else will you place it? Think about it. What is the ideal place to set a stop loss so that if the market reaches it, you know the ascending triangle pattern is invalidated? Since the pattern forms higher swing lows, and if the price moves below the recent swing low and forms a lower low, then we can be sure that our analysis has gone wrong. So it is exactly the place where you need to keep your stop loss. That is, just below the recent swing low level. You can give the price some breathing space by adding one ATR buffer below the recent swing low. I hope it is clear. Now the third and most important point, when and where to exit your winning trades for maximum profits. Now as always, there are two techniques you can consider: the trailing stop loss method and the price projection method. The idea of a trailing stop loss is that we have no idea how long a particular trend will last. So we trail our stop loss to ride the trend as far as possible to lock in your gains as the market moves in our favor. So how do you trail your stop loss? Well, as I have mentioned a number of times, you can use an indicator like moving average. For example, you can trail your stop loss using 50 period moving average for a swing trading strategy. This means you will hold your position until the market breaks and closes below the 50 moving average. Now some of you might be wondering why 50 moving average always. Actually there is nothing special about 50 moving average. A much better question to ask is what type of trends do you want to capture and what is your trading style? Now for a long-term trade you can use the 200 period average. For short-term trends you can use the 20 period moving average and so on. The second method, the price projection method, is a classical charting technique to project where the price will exhaust itself. So here's how it works for an ascending triangle pattern. You have to calculate the width of the ascending triangle from the highest point, which is the resistance level, to the lowest point. Now add this amount to the breakout level and that's your price projection or expected target level. Now, one of the issues with price projection is that the market can almost hit your target profit only to make a sudden reversal, and sometimes it can reverse all the way back and hit your stop loss. So what would you do to avoid something like that happening? The best idea is to combine both the techniques, that is, make a trailing stop loss and price projection combo. This means if the market moves in your favor but it hasn't reached your price projection level, you can utilize the moving average to lock into your profits. So even if there is a sudden reversal, you still protect what you have and do not give everything back to the market. Now the descending triangle is yet another logical pattern, and if traded correctly, it allows you to catch explosive breakout trades about to occur. This is a bearish chart pattern that shows the sellers are in control and it signals a bearish trend continuation. Now the descending triangle looks like a series of lower highs coming into an area of support. The pattern signals strong selling pressure and a lack of buying pressure. Usually when the price drops lower, more demand comes in to push the price higher. But that is not the case for descending triangle, because as the price drops lower, there is still a lack of buying pressure. Instead, the sellers are willing to sell at even lower prices. That's why you get a series of lower highs. Now yet another point to consider is that sell stop loss orders are clustered below the support level. This is because many traders will buy because the price is at the support and they will set their stop losses below the support level, since that's what most textbooks teach them. Now as more traders do it, the cluster of stop losses below the support level builds up over time, and since the market moves from one area of liquidity to the other, the price is likely to break below the support and trigger all these clusters of stop losses, which will increase the selling pressure and pushes the price downwards. Now being a bearish continuation pattern, the most common way to trade a descending triangle is to go short when the price breaks below the support level. Still, there are important things to consider if you want to find the highest probability breakout trades. The breakdown should occur near the apex of the descending triangle. Apex refers to the tip of the triangle pattern where both the trend lines meet. Now the reason you want to short near the apex is that it is where the volatility is the lowest and the prices are squeezed. Now when the volatility decreases, chances are the price will explode out of the descending triangle and quickly move in your favor. On top of that, the more times the support level is tested, the better. This is simply because when the price tests the support level multiple times, it will attract more buyers and thereby increase the number of stop loss orders below the support level. Now this is great for a breakout trader because if the price breaks below the support, all these clusters of sell stop loss orders would be triggered, thereby increasing the selling pressure towards the downside. Now moving on, we will focus on how to trade this pattern. So how to time your entry and set your stop loss. I don't know if you have observed, whenever the price falls, it moves quicker than when it rises. So if you wait for the breakout candle to close below the support level, chances are the price might drop a lot and you end up chasing the market. Thus, in this case, it is preferred to use a limit sell order and enter the trade when the price just breaks below the support level. Now, if you are a more conservative trader and you do not want to blindly place a sell limit order at the breakout point because the price could give a false breakout and rise higher. So it is ideal to wait for the price to confirm your bias before shorting the markets after the breakout candle closes below the support level. But there can be occurrences when you can miss the breakout altogether. What happens then? So if such a thing happens, the last thing you want to do is chase the market after a breakdown of the pattern. Instead, a better option is to wait for the price to retest the breakdown point. Now, if you wait for the retest, you are entering a favorable trade location where previous support is likely to act as a resistance level. This means you have a tighter stop loss on your trade, which offers a better reward to risk ratio. But sadly, pullbacks or retest don't happen very often with this pattern. Also, making use of volumes for the breakout validation is a good practice. Now, what about the stop losses? Straight away ask yourself, the point where the descending triangle pattern gets invalidated is when the price moves and closes above the most recent swing high level. So a good stop loss would be above the most recent swing high level, and if you would like to be even safer, give it some buffer like 1 ATR and set it above the recent swing high. Now finally, how to exit your winners for maximum profits. Now similar to every other pattern, there are two ways to exit the winning trades: price projection method and trailing stop loss method. In the price projection method, calculate the distance between the highest and lowest point of the descending triangle. Now take this distance and project it downwards from the breakdown point. This projected future price point is where you exit your trade after you enter a breakdown of the descending triangle pattern. You can also use the price projection technique to decide whether it's too late to enter a trade or not. That is, if the price is close to reaching its projection, there's probably not much reward left in the move and you might want to skip the trade. Now the second method is using trailing stop losses, and unlike the price projection technique, a trailing stop loss does not have a fixed profit target. Instead, you trail your stop loss as the price moves in your favor, so you can ride the entire trend. Now you have to decide on the type of trend you want to capture, whether it's a short term, medium term or long term trend, and you trade your stop loss with the appropriate moving averages. For example, a 20 moving average can be used for a short term, 50 period moving average for a medium term, and 200 period moving average for long term trends. Then exit your trades when the price closes beyond or above the moving average. So if you want to capture a price swing in the market, the price projection technique makes sense. And if you want to ride trends in the market, then trailing stop loss works best. Now moving to our fourth category of patterns, the rectangle pattern.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.